Hello, this is Dennis Black, and here's your sales tip of the week. As we look at the third and final non-buying attitude, we have to figure out how to handle what many people think is the most challenging, an objection. Objections fall under three specific categories, so let's address each of them in their own merit. The first is, in my opinion, the easiest to deal with, turnaround time. If a buyer states they want to get their loan closed in a particular time frame, or a realtor states they want to write the purchase contract for a specific time frame, our job is to be honest, candid, and discuss what we truly can deliver. Setting an expectation that's unrealistic will not only leave an unsatisfied borrower, but potentially damage a long-term referral client, the realtor. So know your system, understand what you can and cannot do in terms of turnaround time, and include all parties involved. On a refinance, it's between you and the borrower to deal with accurate expectations of when that loan can close on a refinance, knowing your operating system and your operations support. Set a reasonable expectation. So for example, if you feel comfortable, you can close the loan in 45 days on a refinance, and the borrower states they want to close in 30 days. Understand first and foremost why they have that agenda. Then work with them to say, as conditions arise, you can help getting a shorter turn time by meeting those conditions within 24 hours. I will do my part with my operations team to make sure we close in 45 days or less. And the key is that latter part of the phrase, or less, because that gives you room to move, but you know that you'll close in 45 days and you've set a realistic expectation, but also put the burden on the borrower. On a purchase transaction, put that same onus on the realtor to do their part to meet if they want a 30-day close, as well as the borrower. Handling turnaround time is setting realistic objections and then dealing with the time frame you know you can deliver. The second valid objection is product. If a borrower wants a particular product and you do not offer that product, then you're in more of a bind, because now you're in a position where you have to understand why they may want that particular product. For example, if they're looking for a 203K FHA loan and you don't offer it, do you have an alternative that may have equity so they can use that to access to do construction or repair on their property? In addition to that, if they want a 95% loan to value product and you feel you want to offer them an FHA but they don't want to have MIP, then you have to talk to them about the merits of PMI versus MIP and discuss why your 95 or your 97 with a gift is a better product for the borrower. Product objections can be challenging, but you have to know your full product menu to offer alternative products to meet the borrower's need. When a realtor wants a particular product, you don't offer it, ask them what percentage of time do their clients end up needing that product. If it's 10, 20, 30%, isolate the objection, put it into a category, and say 70 to 80% of the time I can handle your needs. If you have an alternative for that minimal percent you talk about, please use them on this particular loan. Realtors have more buyers than one. You have to realize, don't get sucked into one objection, mudding the waters for all their business. Now, the big one, price. When price comes up, it's always tied to a particular product. So let's take the common 30-year fixed rate, and let's say it's 80% loan to value. Now you're in the waters with every other lender. They all can offer it. But if one lender potentially is a quarter or more better on their price, on the rate, or on their points, now you have an option. You have to think quickly on your feet and have asked these two key questions to the buyer before you get into product and price. One, how long do they see themselves staying in their property? Two, are they looking for cash flow or equity buildup as a primary reason to choose their lender? If it is equity buildup and they're going to stay in their property 5, 6 years or greater, the smart play with the interest rates today is to offer a 15-year and explain the merits of the equity buildup position they'll be in if they sell their house anywhere between 5 to 10 years down the road. If it's cash flow, and if we see rates rise, in particular in the second quarter, we may see the 5, 7, and 10-1 products come back into play, and they'll offer a better monthly mortgage payment, and there's your cash flow alternative. Remember to think on your feet to switch the product offering. Based on the answer to those two key questions, how long do you see yourself staying in your property, and is cash flow or equity buildup the primary component you're going to look at before you choose your mortgage? Handling all three of these attitudes, indifference, skepticism, and objections, takes practice, takes work, and learning the key tips we've discussed in the month of January. Good luck and good selling.